Good afternoon, everybody, and welcome to our Equity Release webinar. My name is David Forsdyke, and I'm joined today by Patrick Gower. You will see on the screen in front of you that you've got a picture of me on your left-hand side of your screen, and you've also got our title slide, Innovative Equity Release, in the middle of the screen. Just to cover a bit of housekeeping so you know what else is on the screen there for you. On the top right, you've got a box that says Speaker Bio, and you've got a bit of background information there about both Patrick and myself. You've also got some links in there so you can get in touch with us through email, and I believe there's a LinkedIn connection there as well. Just below that, you've got a box for resources, and what we've put in there for you is the Equity Release survey and some other resources which might be useful. Please feel free to download those and have a read in your own time. At the bottom of the screen, you've got a Get in Touch box, and that allows you to send an email directly to me. I should point out at this stage that if you are watching this via a video recording, then unfortunately none of those functions will work for you, but my contact details will appear at the end of the webinar today. You're very welcome to get in touch by phone or by email. Okay, so that's the housekeeping out of the way. Let me start by introducing Knight Frank Finance to you. Knight Frank Knight Frank is a large global property business employing around 19,000 staff globally. Knight Frank Finance is the financial services arm of that group, and we were established back in 2007 in order to provide primarily mortgage advice to the property business, but we also deal with all manner of secured borrowing, from mortgages to bridging loans to Lombard lending, and of course equity release. I'm going to introduce myself properly. Some of you may already know me, but for those of you that don't, my name is David Forsdyke. I've been involved in equity release since 2005. And between 2009 and 15, I worked for the regulator, the Financial Conduct Authority, as a senior associate. I worked in both the policy and supervisory departments, and I established myself within the regulator as a subject matter expert on equity release. In 2015, I joined Canada Life Home Finance as the head of compliance for them. And at the same time, I was also invited to join the standards board of the Equity Release Council. And it was a pleasure working for them for 2 years. I have since carried on a number of roles for the council. I sit on their advisory panel, providing them with advice, assistance really, in terms of formulating their policies and standards going forwards. And this year, the Equity Release Council formed their risk committee, which I am a member of. So that's a little bit about me. Hopefully I should know what I'm talking about. I shall hand over to Patrick to introduce himself.
Thank you, David. Good afternoon. My name's Patrick. I'm a consultant working with Knight Frank, a writer and an analyst. I spent more than 7 years in financial journalism in London, most recently at Bloomberg News. And since 2017, I've been working with Knight Frank as an analyst across the mortgage finance, global wealth and residential development divisions, largely working on interpreting large data sets and understanding what stories those data sets tell.
Thanks, Patrick. So let's get on to why we are here today. Well, we decided to run this webinar following the publication of our first ever equity survey earlier this month. The survey itself was a great opportunity for us to gather some views from a broad range of consumers of all ages, to find out what they think about equity release, how much they know about it. And the survey has been really quite revealing for us. It's given us some really useful information. I would encourage you to have a read of the survey report that we've published. One of the things that the survey showed us is that consumers who are thinking about equity release are turning to their financial advisors, they're turning to their solicitors, they are turning to their other trusted professionals. So we thought we should take some responsibility here and try and help educate and inform those professionals so that you can steer your clients in the right direction. So what we're hoping to do today is talk to you about some of the findings from the survey, but also some of the emerging applications of equity release. So when your clients do come to you to talk about it, you can speak from a position of some knowledge. I'm going to hand back to Patrick now just to talk us through some of the key findings from the survey.
Thank you, David. And yeah, as you say, the equity release survey has come at a particularly interesting time. Equity release has been in the headlines a great deal, both good and bad. And I suppose the first point that really shone through on the survey is that a lot of people do now or have heard of equity release. Actually, 9 in 10 of our respondents had heard of equity release, but actually most, or 1/3 of them say they know little about it. So there's clearly work to be done here to educate consumers as to the ins and outs of equity release. And something that the survey did throw up actually was that attitudes appear to be changing for the better. About 1/5 of our respondents are willing to take a proactive approach to accessing their property wealth in the future. And actually we found that perceptions do improve as we move through the younger demographics. More than half of respondents aged between 40 and 49 say they believe equity release is a useful tool for financial planning. Now, there are some powerful drivers that we see underpinning the market over the years to come. One of those is the pension shortfall. 40% of pension pots accessed last year had a value of less than £10,000. And of course, our ageing population, you will have heard a lot about this, but sometimes it's worth putting some numbers behind it to offer some scope. The UK's over 60 population is going to climb by almost 1/3 between 2020 and 2040 to more than 21 million people. So there is a growing market or potential market for these products. And not only that, we've of course got this accrual of housing wealth that's taken place over decades. Knight Frank Finance's own modelling suggests a little over 3 trillion of housing wealth is now held by the over 55s, and naturally that has inheritance tax implications as well. The government's own forecast suggests receipts are going to climb to about £6.3 billion by 2023-24. And I think the final point worth making that came through in the equity release survey was a real sort of willingness to engage with professionals. 61% of respondents aged 60 to 69 would speak to their financial advisor or solicitor first when it comes to equity release. But then across all age groups, more than 1/3 say that they would be most likely to speak to a financial advisor. So we've got this increasingly people are aware of the products. Perceptions do appear to be improving, particularly through the younger cohorts. There are some compelling drivers of the market now that are long-term, but there clearly are some kind of gaps in knowledge that are waiting to be filled, really. And it is going to be these professional service providers that do that. Thank you, David. Back to you.
Okay, so something that we do cover in the survey report are some of the myths and misunderstandings about equity release. And I'd like to start by picking out just a handful of these. What you might find from your clients is that they're very nervous of equity release. They're very unsure. They've heard bad things about it. We quite often hear this phrase that equity release is a bit dodgy. And that's understandable because back in the 90s, we saw some very poor value products under the banner of equity release. The good news is that since regulation came in 2004, we've seen a massive improvement in these products, and they are very well protected. In fact, you might say they have the best level of consumer protection across financial services these days. And that's because we've got specific advice rules from the regulator. We've got requirements around lenders from the regulators as well. But we've also got a set of standards set by the Equity Release Council. And these require both providers and advisors to meet very high standards in protecting their clients. So it's a much safer place than it ever was before. Something else that we hear quite often is that equity release is not very flexible. The good news is over really just the last 2 years, the level of flexibility has really improved. Lenders will allow borrowers to make interest payments, so you can effectively have an interest-only mortgage under an equity release scheme. You can have a drawdown facility, make overpayments, talk to your lender about further advances in the future. You can move house and do all sorts of things. It's become a much more flexible product. Equity release used to be very expensive. When I entered this market in 2005, I remember talking to clients about interest rates at 7 and 8%. That has changed quite dramatically. And again, just in the last 2 years, we've seen interest rates dropping. The slide says rates start at 2.28%. That has actually moved on since we put these slides together. And we now have the lowest rate in this market at the moment is 2.26%. That is a rate for a lifetime mortgage, and it's a fixed rate for the life of the borrower. Now, when you think about an average borrower who might be in their early to mid 70s, they might have a good 15 years or more that they're going to be holding this lifetime mortgage. So 2.26% fixed for 15 years is actually a very attractive borrowing rate. Some of the other myths, misunderstandings we've heard is that people worry there won't be anything left for their children. In fact, this came out in one of the comments from the survey responses. People were worried that they effectively lose their property. That isn't the case. With a lifetime mortgage, interest can be allowed to roll up on top of the debt. And with interest rates below 3%, it's going to take at least 25 years for the debt to double in size. That means there's a good chance that there will be equity left in the property. Some customers worry that they're going to be stuck in their property forever if they take out equity release. The good news there is that equity release products are completely portable. In fact, it's under one of the Equity Release Council standards that customers must be able to move their equity release with them if they choose to move home. And we do see a number of clients porting their mortgage across. I'm currently working with one client who is selling his property, moving into a new one. It's a downsizing move to make life a little easier for them, and they are moving their lifetime mortgage with them. And finally, people worry that they will lose control of their home or they won't own their home anymore. With a lifetime mortgage, you are still named on the title. It is still your property. So you can do what you would normally do to your property if you want to make changes, redecorate, bring in a new kitchen, etc. Obviously, if you make any major structural changes, you probably need to check that with your mortgage lender, but it doesn't mean you can't do those things. So that's a bit about the myths and misunderstandings. What I'd like to move on to now are some of the emerging applications of equity release. We've heard for many years now that the most common use of equity release is for home improvements. And I think that's still one of the key uses for equity release, people wanting to improve their property as they move into retirement. But we're beginning to see an emergence of other uses. And the first one we've got here is around pension shortfalls. Excuse me. Patrick mentioned earlier that pension pots have dramatically shrunk. There is clearly an issue for retired people going forwards. But a lot of people have considerable wealth tied up in their property. And we're beginning to see an increasing number of clients turning to their property wealth in order to top up their income in retirement. To give you an example, I recently helped an 83-year-old gentleman who had been drawing down from a self-invested pension plan. That pot had run dry by the time he reached age 83, but he lived in a nice cottage out in Hampshire worth $1.5 million. What we've done for this particular gentleman is set up a drawdown facility with a lifetime mortgage so that he can draw funds down either on an annual basis or on an ad hoc basis as and when he needs those funds. And that's given him the peace of mind that he can continue the lifestyle that he's used to. Effectively, he's drawing his income out of his property. It's worth pointing out at this point that if you set up a lifetime mortgage in this way, the money that you receive isn't actually income, it is borrowing. And it's important that when you're talking to your clients, you remind them that they don't need to put the amounts that they draw down on their income tax returns. I think a lot of clients think that it's income because obviously it looks like income, it feels like income, but it isn't actually income, it is borrowing. And it's important to make that distinction. I've also mentioned on the slide here something called an over 55 buy-to-let. This is a form of equity release that allows clients to purchase let property in retirement and can be used to top up their income. I'm not going to say too much about that because we are planning a webinar on that subject in a couple of months' time. Moving on to another application is around inheritance tax and estate planning. Excuse me one moment. Now, we've had a number of clients and we seem to see a growing number of clients that are looking to equity release to help them reduce the value of their estate. And obviously borrowing against your property and using that borrowing to make gifts to your beneficiaries is one way of reducing the value of your estate. Any gifts that you do make, or rather your clients make, will be regarded as a potentially exempt transfer. But they can also use it to make use of their annual gift allowances. Now, we work very closely with our clients' advisors when looking at this because it is a very delicate area and something that needs to be very carefully considered. But just to give you an example, I had another elderly gentleman in his 80s who wanted to ensure that his grandsons were well funded through their university years. But at the same time, he also wanted to find a way of reducing the potential inheritance tax liability for his sons. What we did is we raised a lifetime mortgage, which allowed him to make some gifts to both his sons and his grandsons. Those gifts are potentially exempt from inheritance tax if he lives for another 7 years. And it means that his grandsons are well catered for through their university years, and the benefit is that we've saved quite a considerable chunk of the potential inheritance tax. We hear this phrase quite a lot nowadays, redistribution of wealth, and the Legal and General earlier this year published an updated report on what they call the Bank of Mum and Dad. And that shows an increasing number of first-time buyers who are being supported by their parents, by their grandparents. And some of that support is coming from equity release. I've had 2 clients very recently who've approached me wanting to help their daughters and also their grandchildren in purchasing property. And it needn't be a huge amount that's involved. If you're a first-time buyer, or if you know anyone who is a first-time buyer, you will know that interest rates on borrowing above 80% are now quite expensive and quite difficult to find lenders willing to lend. So it might be that grandparents can help those first-time buyers reduce their borrowing requirement to 80% or less and secure much better interest rates and a much broader choice of interest rates. Just a small sum of maybe 20 or 30,000 could help them get there. We've also been approached by clients looking to use equity release to assist with school fees. And indeed, this is an area that I think is slowly coming to the fore. Families that want to put their children through private education might turn to equity release just to provide some additional funding. And finally on this set, equity release is being used by an increasing number of clients to simply improve their lifestyles, to try and take some of the worry, the anxiety away from them. There's a lovely picture there of a couple walking on a sandy beach, and I can tell you I have helped. I think it was last year I helped a couple use equity release to raise a small amount of money so they could go on a 3-month cruise around the world. Now, it's something that they'd been dreaming of for many years, and it was their holiday of a lifetime. They borrowed a relatively small amount compared to the value of their property, but it's allowed them to live that particular dream. We have other clients that are using equity release just to simply improve their liquidity, to give them access to funds if they need them going forwards for emergencies or, as we said earlier, for helping out their family. And it's about creating some flexibility. Indeed, the survey has shown us that we've got an increasing population that are looking at their property wealth as part of their overall financial planning. So that's enough about the emerging applications. Let me briefly explain how Knight Frank Finance might be able to support you. Hopefully some of the things we've spoken about today have resonated with you, and the sort of things that your clients might be asking you about. And what we would love to do is be able to help you with those inquiries. So please do feel free to get in touch with me. I'm very happy for people to email or call me directly. Once you've spoken to those clients and you need some further guidance, then we are here to help. If you want us to take things forwards, then we can do that. We can support you through the process. Moving on to Q&A, and I'm pleased to say that a number of people submitted some questions before the webinar today, so I'm going to run through some of those. And then we'll move on to any other questions that might arise. So the first question we had is about interest compounding on a £1 million lifetime mortgage. And if you look at an interest rate of around about 2.28 that was mentioned earlier in the webinar today, it's quite interesting to look at what happens to a £1 million lifetime mortgage after 10 and 20 years. After 10 years, the debt will have increased to around about 1.22 million, roughly. And after 20 years, that goes up to around 1.54 million. So it gives you an idea of how quickly the debt is increasing. If you think about how long it would take for the debt to double in size at a rate of 2.28%, it's going to take just under 32 years to double in size. So it's increasing very slowly. Another question we've had was about the possible lockdown or increased measures from the government that are looming. And indeed, if you're watching this live today on the 23rd of September, you may have seen the Prime Minister make some announcements last night. So the question is, how do we see this affecting the equity release market? Well, when we first went into lockdown back in March, it had quite a big impact on the equity release market. Lenders had to effectively withdraw, and surveyors were not able to go out and value property. I think if we go into a lockdown again, lenders will be much better prepared this time round. They've managed to adjust their working practices, and so have we. So I don't see another lockdown or increased measures having a significant impact. In fact, I'm kind of getting used to seeing a lot of my clients on video screens rather than meeting with them face to face. So I think the industry has adjusted extremely well to the current conditions. I've got a question here that I'm going to hand over to Patrick, if I may. The question, Patrick, is around the impact that the pandemic has had or might have on the outlook for the equity release market.
Thanks, David. Well, actually, there was the Equity Release Council published some data just earlier this week, actually, and it showed the number of equity release plans agreed during the second quarter was down about 14% on the same period last year, which actually isn't too bad when you look at some comparable mortgage market data that has come out through this crisis. The data also showed actually that average rates across the market are down at about 4%, and the product choice is broadening quite rapidly. So when you look at that picture alongside, some of the results of our survey that suggest, a robust proportion of society are interested in being proactive with their property wealth, we're of the view that the outlook remains pretty much unchanged. Growth is likely to continue in a similar trajectory as we saw before, provided we don't see, as David mentioned, substantial restrictions on the operational aspects of the property market, though that looks very unlikely.
Thanks, Patrick. I've got one more question. We've got just enough time to cover this. The question is around mainstream mortgage lenders, as a lot of them are increasing their maximum ages. A lot of them will lend to age 80 or above. And the question is whether this has an impact on the equity release market. Yes, it does, but I believe it's a positive impact. What this shift from mainstream lenders indicates to me is that they are realizing that there is a need to lend in the later life market. Now, my team, we call ourselves the Later Life Finance team, and we've chosen that name quite specifically because we believe in giving our clients as broad a view of the market as we possibly can. It may be that for clients, equity release is not the right solution, or it's not the right solution right now, but there is an alternative way of raising the funds that they want, the funds that they need at that time. So we've got retirement interest-only mortgages. We've got a number of lenders developing what they call retirement mortgage products, and we've got these increasing age limits. And for me, that means just an increased choice, an increased bed of products that I can talk to older clients about and make sure that we find the very best solution for them. So yes, it's going to have an impact, and a very positive one. Okay, we are running out of time, so I'm just going to wrap things up there by saying thank you all for joining us. Please do get in touch by phone or by email if you've got further questions you would like to ask me, or indeed if you've got a client we're talking to who might need our help. Very happy to take your calls and discuss those with you. Hopefully you've signed up for our series of webinars. The next one in October will be going into a bit more detail around inheritance tax planning and how equity release might work in that arena, and I'm bringing in some expertise to help me with that. And then in November, we're going to take a look at equity release in pension planning. There's some really interesting things emerging from that, both in terms of the tax implications and also helping people enhance their income in retirement. So looking forward to that. Please do join me if you can. That's it, I think, from us. Thank you very much for joining us, and I look forward to hearing from you. Bye for now.